Happy Tuesday out there, folks. This is Darius Dale here to present our macro minute for Tuesday, July 19th, 2022. Starting with markets, we have stocks up a bit this morning, commodities down, crypto up, dollar down, global bond yields up. Market moving headlines, conservation equals deflation. And what I mean by deflation is bottom up macro regime deflation from per the 42 macro process. That's where growth and inflation are slowing simultaneously. So President Biden may declare a national climate emergency this week, the Washington Post reported. That would allow him to announce more actions to curb emissions after Senate Democrats yesterday concluded a climate change legislation package is dead. In Europe, where a heat wave is pushing power systems to the edge, the EU would tell members to cut gas consumption immediately, as high usage means it risks running short this winter. So obviously, if you're conserving energy, you're going to be able to produce less goods and services. So that's negative for growth. And obviously, if you conserve energy, it's removing demand from the physical energy space as well. So that on the margin would slow inflation. So that's two things that if we saw come to fruition, obviously Europe's a little bit further along on the legislative front there, that would actually take incremental demand off the table for commodities and incremental demand off the table from a growth perspective as well. So that would increase the probability of the bottom-up macro regime transitioning to deflation. But again, it's just one of many components in the model. Number two, bullish sign for crypto, at least until the courts step in. So Anthony Scaramucci froze redemptions in Skybridge Capital's Legion Strategies Fund after the rout in stocks. Crypto people familiar said that's because private companies, including crypto exchange FTX, now make up about 20% of the portfolio and are harder to sell. So the fund is one of Skybridge's smaller offerings, which is only 230 million assets. So it's not the end of the world in terms of the size, but it is pretty indicative in the kind of things you tend to see in bear markets, where people first sell what they can, not what they should, and then eventually, after some shenanigans, I don't want to cross any lines legally here in terms of what words I use, but after you gate people with redemptions, et cetera, they find a way to get their money out, if only through the legal system, and so that means what people should have sold eventually gets sold, and that's the capitulation that marks the bottom. So it's our view that we have not seen the capitulation that traditionally marks the bottom of bear markets in either crypto or stocks. But obviously, that doesn't mean the market has to go down every day, every week, or even every month for that matter. And then lastly, my favorite thing I like to make fun of and have been since January is this Bank of America's Global Fund Manager Survey. So as I always say, surveys are not actual positioning. This survey conducted July 8th through 15th shows that the outlooks for global growth and profits are at all-time lows in terms of the net percentage of respondents expecting good or bad results. Cash levels are at the highest since 9/11, which is usually somewhere around 5 to 6% at the highs and like 1 to 2% at the lows. And equity allocation is the lowest since the Lehman collapse. That I want to say in October 2008. The bull and bear indicator per this survey, again, is max bearish, and recession anticipation is the highest since May of 2020. The most crowded trades are long dollar, oil, and commodities. So one thing I call out is I saw a chart this morning. Our buddy Win Smart on Twitter here, great Twitter follow, tweeted out the chart of the B of A fund manager survey. And it's like, oh, we're as low as we've been since October of 2008. And I go, man, holy cow, the S&P 500 declined 30% from October 31st to the lows of March 9th of 2009. So how did that all-time low in the survey feel for you there at October 08 signal? So again, this is why I keep going back to the statement I made initially, which is surveys are not positioning. Positioning is what drives markets, and the change in things like growth, inflation, and the liquidity cycle are the things that drive positioning. Surveys are just a sort of outcrop of whoever picks up the phone or answers the emails that day. So they are obviously directionally indicative, but I wouldn't necessarily put a lot of stock in a survey that has very clearly proven itself to be very useless throughout the year to date. If you've been long crypto and stocks. So anyway, big movers, WTI crude oil off another 2% this morning to down 7% month over month. Bloomberg Agricultural Index down 2% this morning to down 14% month over month. And then Bloomberg Dollar Index minus 0.6% to minus 1.1% week over week. It's still up 1.3% month over month, but this sort of fade in the US dollar off the upper boundary of its probable range, which we were well out in front of in terms of giving investors that signal, both from a probable range and crowding perspective, has really caused some reflation in risk assets, particularly in the stock and crypto space, the places where we've seen the most pain. if you're betting on a dollar to have peaked and declined sustainably, then yes, go chase stocks and crypto, et cetera, et cetera. But you're definitely not getting that call from us at 42 Macro. We still think the liquidity cycle downturn is very much ongoing. And obviously the growth cycle downturn coupled with the likely inflection in the inflation cycle will likely put further upward pressure on the dollar in the second half of the year, throughout the second half of the year, and ultimately keep a lot of the trends that we're seeing in asset classes intact. So with that, just kind of wanted to shift gears. Actually, there's one chart I want to show before our volatility adjusted momentum signal and probable range processes. But like I mentioned, surveys is not actionable positioning. What I'm showing here in this blue line is the household equity ownership as a share of overall net worth. And at 28%, we're coming off an all-time high in this indicator. In this data through the second quarter of this year. So they're saying everyone's, as bearish as they've been from a survey position perspective since October 2008. But then when you ask, households, U.S. households, what's your allocation of stocks relative to your overall net worth, your overall portfolio, it's coming off an all-time high. So I just wanted to remind people this is the starting point, not the Bank of America survey, which it's usually really good to get clicks. They're obviously trying to drive traffic and eyeballs. But anyway, U.S. dollar this Bloomberg dollar index. That is still bullish, fams. It's backed off towards the lower boundary of its probable range here. It's got 50 basis points of downside versus 2.1% of upside. Gold bearish, fams. Had a little bit of a reflation with the dollar down move. Finding it, gold definitely didn't have the size of a reflation you would expect in this dollar down move, and maybe be a leading indicator that the liquidity cycle dynamics, which have not changed, are being misinterpreted by the folks who are furthest away from understanding these types of things, which are equity and crypto investors. And I don't mean that to be disparaging. Most of my friends are equity and crypto investors. I just mean that they're probably not paying as much attention to liquidity cycle dynamics. Things like the reverse repo rate, things like the Treasury general account, obviously the Fed's balance sheet, the change in policy rate expectations, as opposed to something like the Bank of America Fund Manager Survey, which I'm sure 100% of equity and crypto bulls clicked on this morning. Again, great catchy for the eyeballs. Anyway, 10-year nominal Treasury yield, that is bullish, fams. Not quite in the middle of the range there. You got 14 basis points of downside versus 29 basis points of upside. High yield credit spreads, bullish, fams. At the lower boundary of its probable range with 74 basis points of upside to the upper boundary. S&P 500, that's neutral, vams. You got about 3.2% of upside to about 39.88. We'd be hard sellers of stocks at S&P 500 4,000, which is again right around the upper boundary of the probable range. VIX neutral VAMs there. VIX neutral VAMs, you got about 9% of downside, 23% of upside in the probable range. NASDAQ 100, that is bearish VAMs, a lot more downside than upside, just based on the skew in the probable range distribution. Russell 2000 neutral VAMs. It's right in the middle of its probable range. You got about 4% of upside versus 6% of downside. Actually, not right in the middle. 2-1 to upside, downside, the upside. Bitcoin, bearish fams, oversold. Ethereum, bearish fams, oversold. This is a dangerous spot to be chasing Ethereum here. You better have a very, very variant perception on my man Vitalik Buterin's Ethereum 2.0. Are we on 2.0 or 3.0? So someone correct me on that on Twitter today. Again, as I mentioned yesterday, the last two times we saw Ethereum break north of its probable range were in late January and late March. And those were obviously not medium-term buy signals. Shanghai Composite, bullish fams, still at the lower boundary of its probable range. WTI, bullish fams, got about 5% of downside versus 14% of upside. Ag, bearish fams, more or less in the middle of its probable range, and then industrial metals, bearish fams, right there as well in the middle of the range. So with that, Darius Dale presenting our macro minute for Tuesday, July 19th, 2022. And if you want to see more actual positioning cycle slides, definitely go check out our macro scouting reports. Our last couple of macro scouting reports have put out in fact, going back all the way since the beginning of January, we actually called that most recent chart out that we highlighted today back out in our January macro scouting reports. So we're doing the work on the positioning cycle. Everybody else can do the work on the surveys, and we'll meet you at the finish line. Cheers.